We'll try not to take up your whole evening today, but we just want to continue with doing these semi-annual check-ins. And Eric's been a fan favorite over the years, and we're happy to have him back and just to have a little back and forth, share some insights. And, the benefit of a smaller crowd is you guys could speak up all you want and interrupt us and ask questions and be interactive. So that's the goal of this. And I just want to thank Eric for being here yet again and spending a Tuesday evening with us. And we're going to cover a lot as always. He's well-versed in charts and graphs and making the complex a little less complex. And we hope that, you guys get a lot out of this. And of course, we record this and we send it out with some notes to everybody because there are a lot of people that do have schedule conflicts that we want to make sure have access to this information in addition to all the stuff that we send out that Eric does on his own, this content we write on a periodic basis. And it's always nice to see the guy behind a lot of what happens in your portfolios that's helping, me and Preston make investment recommendations for what's going on in your portfolios. So, without further ado, Eric, thank you yet again for spending some time with us. And I look forward to hearing your thoughts on what's going on in the world. Because the comment we always get is it's a crazy world. How are markets doing well? So hopefully we could peel back the curtain on that tonight.
Yeah, no, absolutely, Paul. It's always great to be with you and your clients as well, and Preston and the whole Nexa team. So it's and you're absolutely right. This market environment continues to be very interesting because there's no shortage of events that are going on in the world. We have tariff uncertainty, we have higher oil prices, we have geopolitical events taking place in Eastern Europe, in the Middle East. Uncertainty seems to exist all over the place, and the old adage of Wall Street needs to climb a wall of worry really applies here in 2025 and 2026 because it seems like one event after another unfolds for the market, and the investors seem to have the resilience to see right through those risks and to continue to bid stocks to new all-time highs. But it's interesting when you get into the nuances of the market and the details of the market, when you pull it apart into its various pieces, that's where some of the story lies. And some of the things that we'll talk about tonight hopefully will provide some insight in terms of, maybe this market isn't so completely resilient after all, and maybe it's feeling some of the uncertainty and some of the pain that you would expect it to feel given all that's taken place in and around the world. So with that in mind, it's worthwhile to just take a look at what is going on in the market right now. Where do we stand today? What are some of the forces that are driving the market to where it is today? Because the good news that I can share is that there is good fundamental justification for where the stock market is trading. Just short, recently hit new all-time highs is about around this time last week. There's good fundamental justification for that. But there is also good reason to be mindful of the risks that could affect the market as we go through the rest of 2026 and into 2027. So for that, I'm going to share my screen and we will go through some charts to highlight where we are in the market today. And
if anyone has a question in real time, certainly just drop it in the meeting chat on your screen and I'll moderate, or take yourself off mute and feel free just to kind of interrupt Eric, and you'll be able to get our attention pretty easily. So
yeah, absolutely. Just to second what Paul said, if there's any questions at any time as I'm going through, some of this information, please feel free to drop, something into the chat line, message into the chat line, or just unmute and let us know what you have on your mind, because want to make sure that the things that we're talking about are the things that are at the forefront of what you're thinking about. So here we have a chart of the S&P 500, the stock market average, going all the way back to last July. And the one thing that continues to be true about this market, it was true in the second half of 2023, it was true in 2024, it was true in 2025, and it has been true so far in the first 9 or 8 months of 2026, is that this is a market that wants to move higher. We saw the S&P 500 have a tough start to the year. Once we got to the end of January, the market had kind of flattened out a little bit. By the end of February, we had the onset of the Iran conflict, which took the markets down about 10% from their January highs before it was all said and done. But once we hit the end of March, the markets got comfortable with what was taking place in the Middle East and subsequently skyrocketed to the upside. A fantastic month of April and May for the U.S. stock market pushed it from being down 10% from its previous all-time highs to setting new all-time highs that were basically 10% above where it was at the end of January. So that's an extraordinary reversal. And that is a key point to emphasize from the very beginning, is that it is very tempting from an investment standpoint to see events unfold around the world and to think that a portfolio adjustments may be required based off of events that are taking place. And it's very rational to go through that thought process. Attacks were launched against Iran, and we saw a spike in oil prices going from below $50 a barrel back in December up to above $110 a barrel in the month of March. And the idea being, well, that's going to be a disruption to economic activity. That's going to cause inflation. Well, one of the things that we see time and time again when it comes to geopolitical events, it can be the Iran conflict that's taking place right now. It can be the Israel-Gaza conflict. It can be the Russian invasion of the Ukraine. It could be the events of September 11th. It could be World War II, the Korean War, or Vietnam. There may be an initial market reaction. It could last a couple days. It could last a couple weeks, like we see here in this chart from during the month of March in 2026. But time and time again, and this has been true even of the most dramatic geopolitical events that have taken place throughout history, the two that I rank at the top of that would be the onset of World War II and the events of 9/11 in 2001. And what we saw in those events and every other geopolitical event that takes place, there's a short-term market disruption that can last days to weeks. But once the market gets comfortable with the uncertainty, more often than not, we see stocks quickly move to new all-time highs. Just using World War II, for example, we had the Japanese attack on Pearl Harbor on December 7th, 1941. And World War II didn't end until May of 1945. But what's notable is that the U.S. stock market hit its bottom in April of 1942, 3 years before the end of World War II. And there was a lot of uncertainty in terms of who was going to win that war in 1942. Nonetheless, that's when the market bottomed, 3 years before the end of the war. Let's fast forward to 9/11. During the events of September 11th, the stock market traded lower for the first week or two after 9/11. But by the time we got to October of 2001, there was still a tremendous amount of uncertainty. The stock market was back trading at or above where it was before the attacks of 9/11. Markets are tremendously resilient to geopolitical events. And that's what we've seen here in 2026. Once we got to the end of March and the markets got comfortable with what was taking place in the Middle East, subsequently skyrocketed to the upside through the beginning of June. Now, what's notable here is that, yes, the U.S. stock market is trading at new all-time highs, but it's really been a back and forth summer. This has not been a great summer for the stock market. We hit 7620 at the beginning of June, and we closed today at 7691. That's basically 70 S&P points. It's 1%. That's not too shabby. But nonetheless, we basically have gone sideways through the summer. And if we zoom in here a little bit, and we're going to pop here to, I'll just zoom in here to the summer months here, July and August. If you take out these 4 trading days, July 30th, July 31st, August 1st, and August 4th, basically the S&P 500 has gone nowhere all summer. If anything, it would be marginally down if you take out these 4 trading days. So that uncertainty that we feel around us is actually something that we're seeing show up in the market, but it's been a bit obscured by some of the things that have happened along the way in fits and starts and periodic bursts like we've seen. But nonetheless.
And Eric, wouldn't it be a fair assessment to say that, coming off of such a hot end of the second quarter, that we just needed a breather in terms of, what's happening in the stock market, and you see that wild run up, all-time new highs back from pretty much correction territory. So I think that might be something that just people taking a breather, taking some profits off the table, and resetting expectations.
That's absolutely right. And just to build on Paul's great point here, we can take a trend line and basically, it's like a game of connect the dots, and basically take a look at where the market has bounced. Now we broke through this trend line during March because we had a geopolitical event. But if we pull that out, if we extract that out, and we see how quickly the market caught up with this line, what we're seeing is completely normal. The market broke below, but once it came back, got a little bit ahead of itself, got quite a bit ahead of itself in terms of this long-term trend line going all the way back to last August. So this is what's known as consolidation. The market goes too far to the downside, it's going to bounce back towards this line, and bounce back fast is what it did in the first 2 weeks of April. And when it gets too far above this trend line, it falls back to the trend line. And we see in 3 separate occasions, the middle of June, the end of June, and the end of July, we did nothing more than what Paul so well described, is that the market needs to take a breather. It can get a little too far ahead of itself to the downside, and it can also get a little bit too ahead of itself to the upside. So one of the, if you saw the financial news today, there was all this concern that the market's pulling back because there's concern about treasury yields, and the bond market is going, the yields in the bond market are going higher. No, really, more than anything, what we're seeing is a market that's probably gotten a bit ahead of itself here after that burst at the beginning of August. We shouldn't be surprised if we see the S&P 500 fall all the way back to 7,500, and it would be doing nothing more than coming back to this trend line, consolidation, and that's healthy stock market activity, just as Paul talked about. And the good news here is that there is good fundamental justification for what we're seeing in the market going all the way back to last summer, a market that wants to continue to march higher. And for that, we're going to talk about 3 key variables. And these are variables that you can follow at home. So basically, one of the things that I'm going to do is I'm going to show you if, it's one thing for us to talk about it today, but maybe you want to take that away with you and be able to say a week or 2 from now to say, hey, I remember Eric Parnell talking about these fundamentals on a call. I want to check them out for myself to see what's actually happening with those fundamentals, to see if they continue to support the market the way they did when we talked in the middle of August. So the first for that is I'm going to come out here to this Google tab, and I'm going to type in Atlanta Fed, and you can see that I just searched it a few minutes ago just to test it out, Atlanta Fed GDP now. And why GDP now? Gross domestic product, basically the measure of total output in the United States, final goods and services in the United States. The reason that GDP is important, even though it's a number that only comes out quarterly and the market seems to shrug anytime a GDP number comes out, GDP, the output of our economy, is critical in supporting corporate earnings and corporate profits. And why do corporate profits matter? Because corporate profits are the primary determinant of stock prices. If corporate profits are growing, stock prices, more often than not over history, 155 years of market history, have shown this time and time again. If corporate profits are growing and they're rising, stock prices will rise, all else equal. And if corporate profits are shrinking, they're falling, like they were in 2000 to 2002, like they were from 2007 to 2009, and like they have in brief spurts along the way since the financial crisis, the stock market typically falls with that. So the one key that we're looking for this indicator, so if you Google Atlanta Fed GDP now and you click on the link, it's going to take you to a chart. And this is a chart that forecasts the projected growth for the U.S. economy. Right now, it's for 2026 Q3, or the third quarter, which we're in right now. If the U.S. economy is growing, if this green line, which is the key number to look at, this Atlanta Fed GDP now estimate, based off of data, not what economists think, which is the blue line, but based off of the economic data that's coming in the quarter, we see the U.S. economy is projected to grow at a 4% growth rate for 2026. And the reason that's phenomenal is because we're talking about, a $30 trillion economy here in the United States. You add 4% on top of 30 trillion, you're talking about a lot of additional output that's taking place. And that's what we're seeing right now. If we're projecting economic growth to be positive, even 2%, 2% is good, which is what the blue chip economists are forecasting. Even if we got 2%, that's an economy that's still growing. So at 4% GDP growth, this is the foundation that helps support higher stock prices, is that the economy itself is growing. And if the economy is growing, that's going to support corporate profits. Now, one of the things that you might say, if you remember back to your Econ 101 classes, is to say, wow, a 4% economic growth in an economy that's been growing for a while, do we run the risk of the economy overheating? Do we run the risk of having an inflation problem? Because we've seen those types of things break out in the past. So that will lead me to the second indicator that you can watch at home. And I'm going to type in here. So the first one is Atlanta Fed GDP now. The second thing that you can Google is 5-year break-even inflation rate. So 5-year break-even inflation rate. Because the one thing that can cause the economy to slow down or maybe even start to shrink, GDP turn negative, GDP growth turn negative, is if we have an outbreak of inflation. Why? Because if we have an outbreak of inflation, that means the Federal Reserve has to raise interest rates. And they're raising interest rates effectively to take money away from the banks, to take money out of people's pockets to help lower the inflation rate. And that in turn causes the economy to shrink. So if we see that we have an inflation problem breaking out, that may cause the Federal Reserve to have to raise rates more aggressively than the market is thinking. That's something else that can cause the stock market to go down. So
and you guys all remember that from the last couple of years, especially 2022, where coming out of COVID, we had all the stimulus, rates were at zero. The Fed was injecting liquidity or capital into the economy. Come 2020, end of 21, we realized, hey, we got an inflation problem. Everything from eggs to used cars were skyrocketing in price. And then the Fed had to take corrective measures. And you've heard Powell say they got caught flat-footed, I think was his, or behind the eight ball, whatever analogy he used. But they had to essentially raise rates at a historic rate, which is what sent the stock market down 20+% during, from essentially January 1st, 2022 to October, mid-October, whenever it bottomed. And then we've kind of been on a steady rise since then. So, that just illustrates the point of the impact that the Fed can have and interest rates in general can have on the stock market and, how closely those two react to each other.
Yeah, and this is a chart just highlighting Paul's great point here, and I'm going to get rid of the legend that's blocking up some of the chart. This is 2022. This is what an inflation outbreak looks like for the U.S. stock market, where corporate earnings were growing just fine in 2021, but we had an inflation outbreak that saw the headline inflation rate peak out at around 9% in September of 2022. Well, the stock market didn't like that at all because the Federal Reserve had to raise interest rates by 5.5% over the course of 2022 and 2023 in order to stop that inflation outbreak. Well, that sent the stock market, and remember, we're at 78.16 on the stock, or we reached a peak of 78.16 on the U.S. stock market last week and are still at 76.91. This is just 4 years ago. The S&P was at 4,800. At a new all-time high of 4,800 on the 4th of January, 2002, and fell as low as 3,584 by the month of October, basically losing, nearly 20% of its value. They were actually in excess of 20% of its value, during that time period because of inflation. Because the Federal Reserve had to raise interest rates in order to basically take money out of the economy in order to get that inflation rate down. So,
and if you've ever seen Eric speak on these calls before, and we've been doing these now this is probably our 3rd year doing them together, Eric. One of the questions I always pose or someone speaks up and asks is, what are the big things we're watching for? And, almost verbatim, you say, the number one risk to the downside is a renewed rise in inflation. And this is the exact reason. We don't want the Fed to be in a position where they need to fight the fire or flame of inflation by jacking up interest rates, which can, and history shows this pretty clearly, not just 2022, but other tightening cycles as well. You think back to the Paul Volcker eras in the 80s, and this is the result of a tightening cycle, especially ones that are extreme. So that's why, especially even in today's world where We have a new Fed chair, and they're not giving us as much information. As soon as that data comes out, whether it's the employment data or it's the month-over-month inflation data, markets do react in real time to that. And it's amazing to watch the futures around 8 in the morning. As soon as that data gets released, they spike one way or the other based upon whether things are ahead or behind consensus. And that's one of the reasons, is because the Fed isn't really telepathically telling us what they're looking at anymore. And people are just hypersensitive. Investors are hypersensitive to the data that's coming out and making their own assumptions.
Yeah, and it's one of the things that Paul mentioned too is that we have this outbreak of inflation in 2022, and I've said it going all the way back to the summer of 2023, is that the number one downside risk for financial markets going forward is a renewed rise in inflation. Now, that doesn't mean that it's going to happen. I would say the number one downside risk for us getting into our cars to go out for a drive is that we're going to get into an accident. But that doesn't mean that we get into an accident, but it's still a downside risk that we have to watch out for when we get in the car. The same thing true with the markets. And talking about the fundamental justification for stocks being at new all-time highs, you Google 5-year break-even inflation rate, and it's going to take you into the St. Louis Fred database. Basically, we're looking at the data here. This isn't somebody's opinion about inflation. This isn't a financial news headline that's, the news wringing their hands about, like oil prices having spiked, which does have an impact at the gas pump and everything like that. The 5-year break-even inflation rate is a market-priced interest rate so financial professionals that get paid a lot of money in order to go into the bond market and buy U.S. Treasuries and U.S. Treasury inflation protected securities basically will give a signal of what the market thinks the average inflation rate is going to be over the next 5 years. And if we go back to 2022, we can see, we got all the way up here around like 3.6%, which means that there was going to be a lot of inflation we're going to see right now in order to get that 5-year average. And we can take a look at this line going all the way over here to where we are today. Where is the 5-year break-even inflation rate today? About as low as it has been over the last 5 years. Basically, what this market is telling us right now is that despite all of the uncertainty that's going on in the Middle East, despite the higher oil prices that we're paying at the gas prices we're paying at the gas pump, despite how things may feel, inflation is not likely to be a problem for the markets over the next 5 years. Inflation is fully under control from a policy standpoint. Yes, prices are higher and they feel higher, but from a market standpoint, low inflation is something that it can absorb all day long. And the reason that is that if inflation is low, then corporate profits don't need to be that much higher for companies to be making money on an inflation adjusted basis. So we have 2 of the 3 elements in place to support higher stock prices. We have strong economic growth that's being projected, and we have low inflation being projected for the next 5 years. 2 fundamental justifications for what we're seeing help, just for stocks basically being at new all-time highs. Let's come back to the third one, corporate profits themselves. One of the things that we really need to see in order to justify higher stock prices is corporate profits rising and corporate profits growing at a healthy rate. And one of the things that has been extraordinary over the last, several quarters, we have seen profit growth not only be positive, and on any given quarter in the work that I do, I'll take a high single digit. Give me 7, 8, 9% profit growth. That's fantastic. You give me profit growth that's in the double digits, 12, 13, 14%, even better. One of the things we've seen over the last few quarters, corporate profits have been growing north of 20% over the last 3 quarters. That is phenomenal. That is more than anything else, something that is going to help justify higher stock prices. If corporate profits are growing by more than 20%, one of the metrics that you'll hear talked about when it comes to the U.S. stock market is the PE ratio, the price to earnings ratio. It's the primary way that we value stock prices. When the PE ratio is high, stocks are expensive, and it causes investors to say, hey, I don't want to go out and buy anything that's too expensive. I might need to sell or maybe wait until I buy more. When the PE ratio is low, that means stocks are inexpensive and make them attractive to buy. So what is the P? The P is the price, basically what you're paying in the marketplace that sets the valuation. What is the E? The E is earnings, corporate profits, earnings. And, we're getting back to basic arithmetic here. If the E and the PE ratio gets bigger, one of the things that happens is that the PE ratio, because if the denominator gets bigger, the PE ratio gets lower. And the lower the PE ratio means the more inexpensive or attractively priced stock prices are. And that helps new buyers come in and say what might look expensive a year ago now might look inexpensive today, and encourage more buyers to come in and keep taking stock prices higher. And those three conditions that help drive stock prices higher are all in place as we move through the summer months and into the fall of 2026. All right. So,
and Eric, I think it's
now,
interesting when you talk about PE ratios and some of the names that have been in the news this year, because that's something that is a headline grabber. Everybody sees the SanDisk analogy or Micron or and Nvidia at one point. They were all, or Palantir, trading at thousands of times earnings. And Palantir is a great example where they absolutely smashed their earnings earlier this year. They were trading at an ungodly multiple, and came out with forward guidance that was better than anyone expected, and the stock dropped like 45% because it wasn't good enough. So
yes.
to the point about these PE ratios and investors justifying a high stock price, that high stock price or market cap value is really predicated on how attractive the earnings and the forward-looking earnings are for these companies. And you see the euphoria in some of the chip makers or memory or whatever the next one's going to be, and the notion of those couple of companies making headlines and drawing attention and bringing investors in, it's almost like meme stock trading at a point. But when we look at the broader market impact of that, you see the chip makers were, peak to trough this year down 40+%, whereas the broader markets are actually up. So, you just need to be cognizant of that when, we're talking to you in the conference room about how portfolios are allocated, that we're not betting the ranch on any one, thematic sector or anything like that. While you may have exposure indirectly or directly to some of these companies, one of them going berserk or, falling from the heavens really isn't going to have a material impact on your bottom line. So despite what these stories may look like when you're reading them, I don't want people to get too worked up that we missed the boat on Micron because you had a little bit of it, and when it fell off, it didn't hurt you. So we're long-term investors from that standpoint.
Yeah, it's one of the reasons I always love doing these calls with you, Paul, because we're on the same wavelength. Because everything that you just said there is kind of key in terms of what I think investors need to think about as they go through the second half of 2026. And maybe a surprise to investors in terms of what they've been experiencing going all the way back to late last year. Because, it's if for the average investor, if they turn on the financial news on their televisions, or they pick up the financial newspapers and they read through them, one would get the impression that everything that's driving the stock market higher has to do with technology. It has to do with the artificial intelligence, the AI boom that really really picked up steam starting in May of 2023 and truly has done fantastically well over the last few years. But that doesn't mean that it goes up forever. Because one of the things that we've seen, and it tends to be a surprise for a lot of people, because the feeling is like, oh well, all of the stock market action is happening in these tech stocks. But if we take a look at what's been going on in the market, not only for 2026, but going all the way back to the Halloween of 2025, so this is 10 months that this has been taking place and counting. It's surprising for many investors what's actually been driving this market higher to new all-time highs, basically going on 10 months, all through 2026 and back through the end of 2025, because it's not the technology stocks. It's everything else. And it really highlights the importance. Yes, in terms of the portfolio allocations, we are allocated to technology and the communication services and these names that you're hearing in the financial media every day. But we're also allocated to all other areas of the market, value stocks, mid cap stocks, small cap stocks, international stocks, bonds, all different areas of the market. Because at any given time, there's one area of the market will go out of favor, another area of the market goes in favor as a result. So let's dive into that and see kind of what has been happening here, which can be kind of, it's kind of a surprise until you dig into it. So for this, we're going to take a look at the cumulative returns of various segments of the U.S. stock market to highlight what I'm talking about here. So for this, we're going to go back, and we'll go back to the day before Halloween. We'll go back to the 30th of October. And here we see the chart for the S&P 500, up 11+% since Halloween of last year, 10-month return of plus 11%. Fantastic. But the one thing we can't ignore is that the S&P 500 was down 8% since Halloween through the end of March. And we had a fantastic April and May, which brought the stock market up to around 10%. And, without that burst at the beginning of August, basically it's been moving sideways since. And that's a healthy thing. We talked about consolidation and everything like that. This chart does highlight something as a quick aside. When we were in the month of March, we had investors that were concerned about the conflict in Iran. And basically, some said, hey, you know what? I know there's uncertainty here. Maybe it's a good idea if we just step to the sidelines and let this situation play itself out, and then we can get back into the market. And the thing that I always say time and time again is that if you want to get out of the market, wait for the bounce. Let the bounce happen, and then decide if you want to get out of the market. And the reason I say that is because when the market hits a bottom and starts to rally after a period of uncertainty, like we saw here in 2026, it does so fast and furious. Because basically, it took us 2 months for the stock market to fall 8% in the midst of the Iran conflict. It took the market 12 days to get not only back to where it was at the end of January, but to push to new all-time highs. 12 trading days. Basically, what that says is that if you make the decision to step to the sidelines to wait for the uncertainty to end, you run the risk of missing the chance to make all of your money back and then some. And that's basically, we've seen that time and time again throughout market history. The biggest rallies will come right after we've seen some of the steepest corrections. And there's that V-shaped symmetry. So, but one of the things we notice here is that basically virtually all of the gains in the U.S. stock market took place in April and May. You take that out, and the stock market would be largely flat. Let's add in a couple charts, and for this, I'm going to actually turn this into to the SPY. Just change the index measure a little bit. We'll take a look at growth stocks, because this is the S&P 500. It includes the 500 biggest stocks, growth, value, and everything like that. Let's just focus on the growth stocks, because this is where all the action is, right? This is where all the returns are coming from the stock market, according to the financial news, right? So we'll come in here and we'll take a look at the growth side of the market. This is going all the way back to Halloween, so this is 10 months. This includes all of those technology stocks that have been doing so fantastically well in the AI sector. And one of the things we see is that the S&P 500 is up 12.59% since Halloween. Growth stocks are effectively flat since Halloween. And this includes all of those AI boom stocks. This is not where the total return has been coming in the market over the last 10 months. How about those big companies that we always hear about? Microsoft, Apple, Amazon, Tesla, Google, or which is known as Alphabet, the Magnificent Seven. NVIDIA is another one. How have they been doing since Halloween? Well, one of the things we see is that they're down 2% since Halloween. These are the companies that did tremendously well and got that Magnificent Seven moniker, the 7 big companies that were driving the stock market higher through 2024 and 2025. Well, since Halloween, they're down. The tech stocks are not the ones that are driving the stock market higher in 2026. And they haven't been driving the stock market higher since Halloween of 2025. which raises the question to say, oh, well, wait a second, this is a big story that everybody's following. Everybody's talking about it every day and these fantastic returns. What then is driving the stock market higher? And what's driving the stock market higher highlights the importance of diversification. So let's take a look at what is leading the stock market higher. It's the energy sector. The energy sector, and there's an important thing to mention, and I think I've mentioned this in our past sessions together, there are 11 sectors in the S&P 500, and there are 2 that tend to reside at the top or the bottom of the total return list at any given point in time. If technology is at the top, you're usually going to find energy at the bottom. And you flip it over, if energy is at the top, more often than not, you're going to find technology at the bottom. Well, we just talked about all the growth stocks where technology resides basically flat since Halloween. What's leading to the upside? It's energy stocks. Rose sharply in the midst of the Iran conflict. But what we see is that energy stocks were up 25% before the Iran conflict started at the end of February. And even though oil prices have come back down, we see energy stocks that are at new all-time highs 10 months later versus where we were last Halloween. And let's take a look at some of the other areas of the market that are doing well. And I'm going to put a couple sectors in here all at once. We're going to put materials, so raw materials or metals or chemicals. I'm going to put industrials, and I'm going to put a third one here. I'm going to put healthcare stocks. It is these other areas of the market that really aren't getting any attention. Energy stocks, material stocks. I mean, who wants to talk about cardboard boxes and, copper producers? But those are the things that are driving the market right now, as well as industrials. We talk about an economy that is growing at a 4% growth rate. It's because the industrial economy is doing well, basically growing. We've seen a 20% return, nearly double what the stock market has been doing since Halloween. And then there's healthcare stocks. Healthcare stocks, the second best growing, there's so much focus on technology being the fastest growing sector in the S&P 500, justifying all that attention. Well, one area of the market that was mired in a bear market for the last several years has been healthcare stocks. When I say down, a bear market down more than 20% from their peaks. Well, they've really come back to life here since the end of April here, now up 20% since the end of April. Not because their earnings over the last year have been very good, because they haven't. They're the worst growing sector over the last 12 months, but they are projected to be the second fastest growing sector in the S&P 500 over the next 12 months.
And this whole picture couldn't differ any greater from what we saw through like Eric was saying, the AI boom and then the Mag 7 run. That really, it was 7 names that powered the S&P to all-time highs month after month a couple of years ago. So it's encouraging from an investor standpoint to see the market broadening out. And not that the technology names, you're always going to own Microsoft and Google and Amazon. Those companies aren't going anywhere and are still growing. And it's normal for them to take a little hiatus after such an incredible run. But it's nice to see that when those names do fall from the top, that there are other pieces of the market that really pick up the slack and still have the power to push a diversified index like the S&P 500 that admittedly is weighted very heavily towards tech and communications. And these names that, represent a smaller portion of the pie are still bringing the market as a whole, as, most people view it, to all-time highs. So I think this is something that, a lot of people don't realize, like Eric was saying, when you see the news. But this, these blue chip companies, these value stocks, that growth versus value debate that we've been having, like, why aren't we all growth? Well, if you were just all growth, you would have missed out on, the returns that you're getting in some of these sectors that just don't get as much love because the story isn't as sexy as, Amazon or Google and anything AI.
Yeah, it's such a great point, Paul, because that's the thing. Saying all that is not a knock against the technology sector, because, man, I mean, it did so phenomenally well from the summer of 2023 through Halloween of 2025. And it deserves the attention that it gets, because the other thing is, it's cool things that they're doing. It's exciting. It's cutting edge. It's revolutionary. So, we continue to be allocated to those areas of the market. but it highlights the importance of diversification because the market is a team effort. And it's not just growth all the time because, growth has done fantastically well during the period from basically going all the way back to 2016 up through about, 2017, all the way up through about 2024. But then we look at value stocks here more recently. As growth stocks have effectively been flat since Halloween, value stocks are up 27.5%. The boring companies that are trading at discounts that people don't like to talk about has been the engine for the market over the last 10 months. And one of the things that we have historically seen is that, in any 2 to 3 year period, growth and value will rotate leadership. It kind of follows the economic cycle. It has been highly unusual that growth has done so well for so long at the expense of value. And that doesn't mean that we don't want to continue to own growth, but we are focused on trying to be style neutral, recognizing, hey, we want to participate when growth is doing well, but we don't want to ignore value because value is going to have its day at some point, like it's had over the last 10 months. And at the same time, if value is doing well over the last 10 months, that doesn't mean that we want to ignore growth because their story there is very much real. And as to Paul's great point before, after such a tremendous run, these areas of the market have to go through some sort of consolidation, take a breather, catch a breath. And that's likely what we're seeing right now, is that this area of the market, letting the valuations, let that E catch it. Paul talked about stocks like Palantir before having a great earnings report and they'll be down 45%. It's because the E needs to catch up to that P and basically that's the health of a consolidation period. But you have the other areas of the portfolio picking up the slack. So that's growth versus value. Some other areas to talk about here. We talk about mid-cap stocks, small-cap stocks, and international stocks. So basically, the blue line are mid-cap stocks up 20%. We got small-cap stocks, the red line that's nearly double what the S&P 500 is doing right now. And international stocks, basically 4 percentage points higher than the S&P 500. All of these areas in the market. And this is a healthy thing. This is something to get excited about because one of the things that we want to see in a healthy market, that it's not just tech and large cap growth that's driving stocks higher, that everybody's participating, that all areas of the market are along for the ride. And that sometimes those areas of the market can step in and take the lead when the former leader has to take a break and, maybe catch a drink of water and catch its breath. And that's what we're seeing right now. And that's fantastic because it's not just the fundamental support, it's a broadening of performance across the market that we're seeing right now.
Yeah, and just to be clear, the 3 lines that Eric just added for small cap, mid cap, and international, those aren't captured in the S&P 500 as, we would look at it, right? Those are the S&P 500 is limited to the 500 largest companies. These are other areas of the market that, of course, we have allocated to within the portfolios because they represent a large portion of the investment universe. But, the S&P 500 is what you see on TV and the numbers that most people track. This just goes to show there are other investment opportunities out there that we've, forever been allocated to, and now they are just performing at the levels that we like to see in a healthy market environment. So I want to make sure we have a distinction between what the S&P really covers. Whereas, Eric just had up previously, he had, healthcare, materials, industrials. Those are pieces of the S&P. These are other pieces of the investable world, so to speak, that are also having a really good year so far. And actually that performance extends to last year as well, specifically for the international stuff, both developed and emerging markets, which had a killer 2025.
Yeah, that's absolutely right. I'll even throw emerging markets in here just for added, say it had a killer 2025 and continuing. That's the purple line in here is emerging markets, just added diversification, recognizing that, yes, artificial intelligence will transform the world over the next decade, and there's going to be a lot of growth connected to that. But one of the things we saw, because the last time we saw a revolution like this was 25 years ago with the advent of the internet, is that as that usage and as that technology becomes more prolific, its impact spreads beyond just the providers to all of the recipients and all the beneficiaries, which are all the other sectors of the marketplace. And that's something that's, that it should help support continued gains, even if some areas of the market fall out of favor. If the tech trade starts to break down, these other areas of the market can continue to perform, particularly because they've been overlooked a lot over the last few years and trade at some of those discounted valuations, which help explain why we see value stocks up 27% over the last 10 months.
And Eric, this may be a good time to touch on, now that we've covered the major asset classes, and I know bonds always get left by the wayside, so I think we should certainly touch on that for a second, but also, what is going on within, we'll say, the core portfolios in terms of, our views, what we own, what we've recently added or deleted or changed the weights of, because there has been some changes this year. And I think it's interesting to tie, your commentary to what people are actually experiencing in their portfolios if they went down the line, say, ticker by ticker.
Absolutely. And that's a great question, because it also brings us back. I talked about a renewed rise in inflation being the number one downside risk to the financial markets. Well, let's talk about the number two downside risk to financial markets. And it has to do with liquidity and potential investor risk aversion. And one of the places that we see that starting to crop up a little bit is, we'll go to the bond market here. So here we have a chart of the U.S. 10-year Treasury yield. So this is government bonds. And the reason that we take a look at the 10-year Treasury yield is because pretty much everything is priced in financial markets is priced off the 10-year Treasury yield. Stocks are priced off of the 10-year Treasury yield. And basically what happens is that as bond yields go higher, bond prices are falling lower. So basically, as bond yields are going higher, that means the bond market is falling. You kind of have to read your bond charts upside down, and I'll actually pull up a security to kind of show how this works. Here's a chart of bond prices. And we can see that bond prices since last October haven't really done all that well. I mean, it's been, it's been about a 10% drop in bond prices going back to last October. So, and that's basically shown in the fact that bond yields are rising. And
now that doesn't mean you lost 10% by owning bonds, by the way.
No.
Because one, there's the income component that these bonds generate, which is, for at least what Eric just had up there, those long duration treasuries had a yield of probably somewhere in the high 4 percentage point rate that would offset some of that price decline. But also the longer duration, the 10, 20, 30-year bond securities are much more sensitive to this change in the treasury rates that Eric's showing. So, something like a 20-year treasury is going to be far more sensitive to a change in the rate and experience a much larger, appreciation or decline based upon what happens with this 10-year yield that he's pointing out here. So, I don't want that to be a panic like, oh my God, my bond allocation lost 10%, because there are plenty of parts of the bond market that, are either flat, up, or whatever. That was a more extreme illustration of maybe what an investor would have experienced. And by the way, we don't own a ton, if any, of long-term bonds. We haven't for a while. So that was an allocation we got rid of. Eric, you could tell me, but it was probably at least a year ago at this point.
It was over 2 years ago. So, and to Paul's point, there's two key points there. The first is, and it's also true of stocks. The dividend yield that you receive from stocks will be the primary part of your total return over long-term periods of time. In short term, it's the price change in stocks. In the long term, it's the dividends that you receive from stocks, assuming they're a dividend-paying stock. It's even more so true with the bond market. Yes, you will see price fluctuations in the bond market at any given point in time, but the coupon payment, the yield that you're receiving from your bonds, are going to be the primary determinant of your bond returns, not the price fluctuations. So, and to Paul's point, the first thing I'll say is that a 10-year Treasury yield, like the markets are getting worked up right now because they're saying, oh, we've seen Treasury yields rise. It means you give me a Treasury that's yielding me 5% on a 5% annual yield, I will take that all day long. And the reason I'll take that all day long is because if we go back, and I'll cut it off at 1986, just because you get before that. You go back and we had 10-year treasury yields at 4%, 5%, 6%, all the way back into the 1990s, into the 1980s. And I'm sure some of you can remember the period from 1982 to 2000 was our longest economic expansion in U.S. history. And we had a 10-year treasury yield at 5%. That was a good thing because it gave you an alternative to invest in other than stocks during that time period. Because unlike we saw during the post-financial crisis period, where you might get 1% from your bond market, you get 5% from your bond market today. That's something to be excited about. But we've seen some short-term pressure here in prices. And I want to get back to Paul's point here. And I want to clear some of these lines off the chart because they're making them a little bit busy. And because we're talking about treasuries, I'm going to put the color here in green because it's just a little bit more appealing to look at. And let's go back to 2025 and to July here. So I'm going to put this chart up here. This is the extreme example, and we don't own these types of bonds. And we haven't owned these types of bonds for a long time. We are seeing increased risk for inflation. We have seen the 10-year treasury, we've seen the Federal Reserve raise interest rates from 0 to 5.5%. And we've seen the 10-year treasury yield rise from 0.5% back in 2020 to nearly 5% today. This is an environment where we're seeing more bond market volatility. When treasury yields are steadily falling, like they were from 1981 to 2022, from 15% in 1981 to 0.5% in 2020, that's a good time to be what's known as long duration. Owning a security like we see in front of us here, this TLT, which is long-term bonds. But if you're in a period where you have interest rate volatility and you have higher interest rates, the best strategy to do is what's known as go to short duration. And for that, let's basically put a new chart up here. And actually, I'll put a comparative chart of the two. That might be helpful to see. So let's go here. We'll go 2026. We'll take this back to October. And I'm going to punch in this TLT again. And we can see that, it's down 5% on a total return basis going back to last October. But then let's take this. These are long-term bonds. Now let's take a look at shorter term bonds. And for that, let's do it like an SHY. One of the things that we started doing in our investment strategies going back 2 years ago, and one of the things that we continue to do, and something that we did with our most recent rebalance, is to increasingly emphasize shorter duration bonds in our model portfolios. And the reason that is, if we're in an environment of bond price volatility, where interest rates are bouncing around, well, we got a high yield on the front end. We can get 4% for lending to the U.S. government for 3 months. And we don't have to worry about price volatility on the short end of the yield curve by being short duration. So one of the things we're doing in our fixed income side of our strategies, let's get rid of the price volatility because I can collect that 4 to 5% coupon and not take on a lot of price risk. And what that enables me to do is to generate a positive return in bonds because all I'm doing is clipping the coupon and I'm taking away a good portion of that price volatility. There is some price volatility that's in there, but allowing the coupon to drive the total return, taking something that could be negative, and the same did the same strategy in 2022 in terms of the strategy that drives these model portfolios now. If the Federal Reserve is going to give you a high interest rate, let them give you a high interest rate. Don't fight the Fed. Shorten duration, take away that price volatility in bonds, and just allow the coupons to be collected. And that's basically what we have continued to do on the fixed income side of our portfolios to generate a positive return where it could otherwise be a negative return.
Yeah, and that chart just illustrates very clearly the volatility difference, the black line being the longer duration or more interest rate sensitive securities where you could see the peaks and valleys are much more dramatic as compared to the short term. And that forget where it ends up on the whether it's positive or negative at the end of the day, just the magnitude of the changes in that line illustrate how bonds can actually be quite volatile, and they don't always they're not always that safe investment if you're in something that is maybe a little longer duration. And that's part of what you guys rely on, myself and Eric and his team, to make those decisions to own or not own that, because that's a very strategic play if you are going to take on that duration risk. That drives the volatility in that, and it needs to be the right market to even opportunistically want to own that.
Yeah, and to Paul's key point there, there's a time when you can own duration, like it was from 1981 to 2021, but now is a time when you have to trade duration, and it is very tough. Just like it's tough to time the stock market when we have the uncertainty of the Iran conflict or anything else that may be afflicting the market at any given point in time. It's also tough to time the bond market, because as this chart shows, you can get areas of the bond market that trade like stocks that are highly volatile. And the way we want to use the bond market as we go through the rest of this decade is to say, hey, you know what? Before it was only giving us a 1% income. Now it's giving us 5% income. Let's collect that, and let's be a little bit more strategic around how we're collecting any additional total return in the bond market, but neutralize the risk and capture the positive.
So Eric, I know we're getting close to time here. So anyone out there that has a specific question you want us to touch on, absolutely, fire it in the chat or unmute yourselves. We're happy to, take them live. Other than that, I would say anything else notable that you think we should be talking about, kind of in closing with respect to what's on deck for the rest of the year, portfolio wise, anything notable that we should be talking about that maybe we haven't brought up, in one-on-one conversations, and just kind of some thoughts around those things.
Absolutely. So, and again, as Paul said, if anybody in the audience has any questions, please feel free to unmute your microphone and you can ask, or you can always drop, a message in the chat line, and we can answer it there as well. Any questions that you have, be happy to answer. I think there's two key things to watch for as we go through the rest of 2026. It's a theme that we talked about back in January, and it has really continued to be true as we go through 2026. The AI boom has become an AI arms race. Companies that once used to generate copious free cash flow, which is another way of, fancy way of saying, hey, we got extra cash sitting around after we've covered all of our expenses, the things that we can, things that we can use to finance or, to help grow our business. Well, these prolific free cash flow generators, like, these mega cap tech stocks, are now negative free cash flow. They are spending like crazy, and they are borrowing, and they're issuing equity, because there is a recognition across the AI landscape. It's either kill or be killed. There's going to be winners and there's going to be losers, and they have to spend to stay out in front of each other. So one of the things that we need to be prepared for, and we've started to see it since Halloween, is that the winners that we've come to know and love for so long over the last 10 years, some of those stocks may not perform as well as they did. And that doesn't mean that they're going to do badly, but we need to be prepared for more volatility and maybe some more pronounced downside in some of those names. And that's another thing that we're adjusting for in our portfolio strategies for you, is the recognition that, the trade and technology might become more volatile going forward than it has been in the past. So that's one key theme to watch for as we go through the rest of the year. And then the other key theme to watch for is basically, we're seeing it play out in the Treasury market right now. We're seeing it play out in terms of the interest rate environment. We're likely to see the Federal Reserve raise interest rates. It could happen as early as September, but the expectation is that we'll see 2 rate hikes from the Federal Reserve between now and next October. That's not a bad thing. If the market feels as though the Federal Reserve is raising interest rates to fight inflation pressures, is one of the reasons why the 5-year break-even inflation rate is so low, is because it's a signal of confidence that the Federal Reserve will do what it takes to keep inflation under control without upsetting the markets. But if it's a situation where we do see inflation pressures continue to rise, that could also unsettle the markets along the way. Not in a dramatic way, but it's something that could lead to some volatility if inflation starts to come in. hotter than expected. So I saw some messages go into the chat line, so I'm going to click in there and make sure we answer questions. But so those would be the two key things to watch. The last thing to watch in terms of opportunities for the rest of the decade, so just go a little bit longer term. There is a reason why countries around the world are increasingly emphasizing commodities and where their resources are coming from. Because there is a huge infrastructure that needs to be built out. And there's also a recognition as we move from a world that's less globalized and more deglobalization, that you need natural resources for security purposes. That lends well to real asset strategies, things like infrastructure, things like commodities, things like precious metals. Those components are already in the model portfolios, and that's likely to continue to be a focus as we go through the rest of the decade, because with it will come opportunity.
Awesome. Well, we just got a couple of thank yous in the chat, so nothing that you need to address directly, but I, again, appreciate your time, and we're going to certainly do this again when the clock strikes 2027, and I'm sure we'll have much more to talk about over, based upon what transpires over the next several months. But again, thank you, Eric. Thank you to everybody for joining us, and, we'll see you soon.
Hey,
Thank
Paul.
you, everybody.
Paul?
Oh, hey, Dust.
Hey, I wanted to ask a quick question.
Shoot.
What do you see in terms of not only short-term and long-term, in terms of the onshoring, the investments in manufacturing, investments in the supply chain, such as chips, solar panels, et cetera, just as a couple of quick examples. How do you see that playing out both in the short term and the long term in terms of making us a little bit more independent and less dependent on maybe some outside resources that we really have limited control over in many situations? How is all that going to factor in not only the short term but the long term?
Yeah, no, it's a great question, and I think we're only at the beginning of what I would refer to as a great onshoring cycle. One of the things that the wave of globalization, it started with the end of the Cold War back in the early 1990s. It continued when China was welcomed into the World Trade Organization. Really, from 1991 up through the late 2010s, we were in an era of globalization where, production possibility frontiers and, specialization in terms of who's the lowest cost producer. And that led to a lot of growth around the world. It also led to some, decay in terms of a lot of communities around the U.S., and it led to, a fair amount of income and wealth disparity at the same time. One of the things that we've started to see really over the last decade, and it is only likely to accelerate going forward, is as we move from a world of globalization to a world of spheres of influence, and there's three primary spheres. There's the United States, there's Russia, and then there's China, and then you have your wild card players like Europe and India that reside in the middle, in the fringes of those spheres. That it is going to be imperative from not only an economic growth standpoint and the sustainability of economic growth standpoint, but also from a national security standpoint, to increasingly onshore production. And one of the reasons why it's timely for us here in the United States is that, yes, are we still a higher cost producer than maybe like some of the really low cost economies around the world? Sure. But we're a lot more competitive from a cost and price perspective than we were 20, 30 years ago. So that is an evolution that's likely only at the beginning. We're likely to become more efficient and more profitable in terms of our ability to do that. But that's something that I think we should expect to see for the next 10 to 15 years.
Cool. And I would also think that, the tariff rates, especially on those lower cost countries, are having a greater effect at normalizing our costs relative to importing, especially resources and durable goods, so to speak.
Mm-hmm. Yeah, absolutely. And the markets adjust to tariffs. As long as the market gets the tariffs that it's anticipating, and that's what led to the volatility in the first part of 2025.
Yeah, we won't soon forget that one.
but as long as and under both, and we've seen it over time. I mean, we've seen tariffs going back 10, 15 years now. Once the market can adjust to those, there's an adjustment in the short term, but in the long term, they can adjust to those new prices.
And one quick additional question: how do you see this as we're transitioning, or at least starting again to put more emphasis on the trades and
Yes.
the importance of that? And not that, as all of us are here, are college educated, but the trades have been, ever since I've been in high school, kind of looked at as a second cousin. Looks like they could be well positioned to be quite a growth engine in regards to the outlook for the an evolving and growing economy and diversification. What do you see
I think
there?
absolutely. I see the same exact thing, because you're absolutely right. I think back in, I'll speak anecdotally, but it feeds to the broader point, is when I was going through high school in the 80s and the 90s, the trades were on the wane. And everybody was focused on trying to go off to college and get the 4-year degree. Well, as time has passed, one of the things that we've seen is that there is a definite shortage of people in the trades. And the trades of 40, 50 years ago have become very specialized. I mean, you need to be skilled and technologically savvy in order to be a carpenter or a plumber, or to be involved in manufacturing, to be in an assembly line in manufacturing. And I have family members who work in manufacturing, work in in production. It is amazing how much that has changed, and the career opportunities that go along with that, in terms of the money that you can make going into the trades, is just as good, if not better, than what a lot of people are finding coming out with a college degree from a lot of colleges anymore. And I think about the high school curriculum. It's the trades. You see a lot of students now that are moving out of the traditional high school curriculum and going into these trade programs. I see it in the school district for my sons, and that's happening nationwide. The other thing too that provides us with an advantage in terms of onshoring production is that there are communities across this country that have been left in decline going all the way back to the 1980s. But there are people that are there that are willing to work, that are eager to work. And they provide destinations for production to come back on shore, and be able to do it at a reasonable cost, because they're basically bringing life back to a lot of these communities that had been left behind during that period of globalization. That is also a trend that is likely to continue over the next 10 to 15 years. It will be gradual. It will go in fits and starts. Some places will do better than others, but that shift is already underway, and it has been underway for a while and is likely to continue.
Well, I remember what a plant manager said to us at one point when when they came back for a meeting. Never forget him saying, when you lose the ability to make stuff, you lose the ability to defend yourself.
Yes.
And boy, is that true in today's world.
And you nailed it right on the head. And that's why it has to happen. Because in the spheres of influence world, like the one that we lived in, basically from the 1910s through the 1980s, you need to be able to manufacture. You need to be able to produce your own products, because otherwise you run into what we saw during COVID: supply chain disruptions that can really disrupt your economy and shut your economy down.
Thank you.
Thank you.
Very well. Well, thank you guys for humoring us and going late. And if no one else has any other questions, I will say have a wonderful rest of the day and rest of the summer, and we'll look forward to seeing you soon.
Thanks, everybody.
Thanks again, Eric.